LiteFinance, the
Hello guys, today's video is exceptionally posted on Tuesday due to short holidays of mine, and it will be also a little bit shorter due to holidays in the biggest markets. So the trading can be cramped in the middle of the week, but we might get also a surprise on Friday. So without further ado, let's begin with the calendar. Yesterday there was no super important data published. Today also we will get only CB consumer confidence from the US. On Wednesday only crude oil inventories. On Thursday we will get final GDP readings first from the UK, then the US, and at the end from Canada. Finally, Friday is a holiday in many countries, but there will be published data such as US PCE inflation, which is the data that everybody is waiting for since it is the preferred inflation gauge by the Fed. Also, Fed Jerome Powell will participate in a discussion in a conference held by Fed from San Francisco. So, we can potentially have some big moves before closing of the FX markets because banks have holidays, so there might not be as much liquidity. And when we add to it a publication of high priority data, it can contribute to high volatility. So now let's continue with the fundamental analysis for Euro-USD. It must be understood that in the current cycle, reducing rates is not a stimulus but an antidepressant. When the ECB raised borrowing costs to a 4% plateau in September, Euro area inflation was 4.3%. This is real estate's fluctuated around zero. Now, as the CPI fell to 2.6%, they rose to 1.4%. The same figure for the UK is 185. This hinders European economies that are already weak. The US economy, on the contrary, is strong. Massive fiscal stimulus due to the pandemic, the associated rise in excess savings, the influx of migrants, artificial intelligence technologies, and sharp productivity growth are allowing the US GDP to expand by 3% or more. Such an economy can withstand high real rates. Moreover, its retakeoff instead of a soft landing accelerates inflation, forcing the Fed to think twice before easing monetary policy. Bloomberg experts expect the personal consumption expenditure index, the Fed's preferred inflation indicator, to accelerate from 0.3 to 0.4% month-on-month. The 3-month indicator is ready to show the fastest rise since May, and the 6-month indicator will also accelerate. Isn't it too early to switch to monetary antidepressants? Due to the US economic strength, the Fed can ease monetary policy slower than the ECB. The federal funds rate could remain above 5% at the end of 2024, while the ECB rate could drop by 75 basis points at the same time. If so, the US-Germany yield spread will widen even more, and the Euro-USD will go down below 105. Thus, market views are changing. Investors are shifting their attention from the timing of monetary easing to its speed. The ECB is likely to act faster than the Fed. Therefore, I suggest selling the Euro-USD further. The price has reached the first target at 108 so far, and we are waiting for the second one. And that will be all from my side. Thank you for watching, guys, and till next time.